Welcome to the American Academy of Actuaries webinar, Church-Sponsored Retirement Plans, Plan Considerations and Issues Around PBGC Eligibility. Thank you for joining us today. I am Linda Stone, the Academy's Senior Retirement Fellow. I will be the moderator for today's session. The webinar will review two recently issued publications, Church-Sponsored Retirement Plans, Overview and Considerations, an issue brief from the American Academy of Actuaries, and improved communication needed on church plan eligibility for federal insurance coverage, a report from the U.S. Government Accountability Office, GAO. Speakers will discuss the impact of being a participant in a church-sponsored plan, as well as governance and fiduciary responsibilities, funding approaches, and the impact of bankruptcy or termination on participants. GAO representatives will provide highlights of their report, including data available on church plans and federal and state roles regarding church plans. Before we get started, I'd like to point out a few tools on your screen that can maximize your viewing and engagement experience. The individual windows are resizable and movable, so please feel free to move them about to get the most out of your desktop space. You may expand the slide area and the media player by clicking on the arrows in the top right corner of those windows. The slides from today's webinar are available in the Slides and Resources section. For answers to some common technical issues, please click the Help button at the bottom of your screen. Webinars like today's are part of the Academy's service mission to the public and the U.S. actuarial profession. The Academy informs the public of the role and value of actuarial work, delivers value to members, assists policymakers in the formation of sound public policy, and sets professional standards for U.S. actuaries. The presenter's statements and opinions are their own and do not necessarily represent the official statements or opinions of the ABCD, ASB, any boards or committees of the American Academy of Actuaries, or any other actuarial organization, nor do they express the opinions of their employers. With that, I'm pleased to introduce our presenters. We are very excited to have these experts with us today. Tom Vicente, who is Vice Chair of the Public Plans Committee, has extensive experience working with church plans and was part of the Pension Committee Working Group that authored the issue brief. The Academy is pleased to be hosting this webinar jointly with the GAO, who will be presenting the excellent work that they did in this area. Representing the GAO today are Chris Wen, who is Director of the Education, Workforce, and Income Security Team, led the GAO response, as well as project leader contributors, Frank Tedesco, Chief Actuary, Mark Glickman, Assistant Director, and Ted Burrick, Senior Analyst, who will be the GAO's primary presenter today. I will start by providing an overview and context of the Academy's issue brief, and Tom will discuss participant considerations, governance, funding, and plan termination insolvency issues. Ted will then review the GAO report findings, and we hope to have time to take some questions. I think it is important to emphasize before we get started that church plans run the gamut in size and structure. Church plan designs vary greatly and have varying operational practices. Therefore, comments made today should not be interpreted as applying to all church plans. And please feel free again to put your questions in as we go through the presentation. Church-sponsored retirement plans have been around for over 100 years and cover millions of participants. These plans are an important component of retirement security for those who are covered and rely on them. The Academy published an issue brief in 2021, The Security of Pension Plan Benefits, which discussed different types of pension plans, such as those sponsored by state and local governments, private plans, and multi-employer plans. Church plans were briefly mentioned there. The lack of centralized data source makes it challenging to understand the prevalence and financial status of these plans, as Ted will discuss later. With the congressional request to the GAO, which you will hear more about later, and the brief mention in the previous work done by the Academy, a more comprehensive look at church plans is aligned with the Academy's mission to inform and educate public policy stakeholders and its members. The issue brief is not a legal document and is intended to be a high-level overview of relevant issues for those audiences. ERISA exempted church plans in 1974, so it was there at enactment 50 years ago. In 1980, Congress modified the law to broaden the church plan definition to include employees of church-related tax-exempt organizations, such as hospitals and schools. They also allowed certain other plans maintained by church pension boards, which have as their principal purpose plan administration or funding, to be treated as church plans. While church plans may irrevocably elect to be covered by ERISA, the issue brief and Tom's remarks focus on plans that do not elect to be covered by ERISA. Church plans are not subject to the majority of ERISA requirements and are also exempt from many Internal Revenue Code rules that apply to tax qualified plans. There can therefore be a trade-off in church plans between flexibility in areas such as funding and those that lead to lower administrative costs versus less transparency and participant protections. Tom will elaborate on these trade-offs. So go ahead, Tom.
Thanks, Linda. So just to flip back to the slide here, there's a lot of no's on this slide. No funding rules, no government filings, no participant communications, no PBGC. It's almost like summer vacation for pension plan sponsors there. But it's the idea here is that it's very appealing to sponsors of church plans that they don't have as much strict rules to follow and regulation to follow. And it can really lead to a lot of inventiveness and different approaches to providing retirement benefits through pension plans. But there is this balance, and we'll hear it over and over again, the theme of this flexibility and lack of regulation versus the risk and the exposure for the employees. So we just want to emphasize that. So we looked at things and we said, well, what are the positive impact aspects of church plan setup or regulation or lack thereof in the United States for both the participants' point of view as well as the employer's point of view. And so we'll start with some of the things that participants might have an appreciation of, or which benefit participants who are members of church organizations. And just to echo what Linda said, there is a lot of differences in big programs. So we have, in the United States, we have big national programs that cover employees and organizations throughout the entire United States versus other organizations which are very regional or very localized. And as you can imagine, if you work with pension plans in the private sector or the Taft-Hartley space, that makes a difference how big versus small goes. So, there's levels of sophistication that are here in some places, but not others. When you look at the employee advantages, the participant advantages, the design opportunities are clearly one of them. Some of the things that restrict the design of hybrid plan designs, for example, in the ERISA covered plan world don't exist, which can lead to a lot of opportunity for specialized plan designs that can help these plans meet their goals of providing retirement benefits. There's also more flexibility in payout options. What can you do in terms of lump sums or annuities or increasing or decreasing annuities? All those can be on the table for employers to provide to the employees, which just provides, again, a lot more appeal for the employee. And the third one on here, targeting to specific groups. Those of us who worked in the single employer private sector space are well aware of all the non-discrimination rules that exist. But in the church plan operations, there really isn't that restriction. And so if you have a situation where you do need to provide some sort of a targeted benefit to a specific group within your organization, you can do so in a way that doesn't have the same restrictions and the same testing that you have in the more highly regulated ERISA group. So it gives you more control from the employee standpoint to get benefits that really focus in on you. Portability is an often overlooked area here. So within some of these big plans, again, we mentioned national plans, employees can move between different plans, between different locations of work. You might think of as a church organization in Ohio being separate from one in Texas, but if they have a good umbrella organization over them, employees can move between the two of them and retain those benefits or some aspect of the benefits. So there's a lot of portability aspects that can really be enhanced with church plans. That's more in the sort of the traditional church group. You have some of your church groups or church plans which may be traditional, what we think of as private sector organizations such as hospitals. They might have less of this portability, look more like a corporate plan, but some of the traditional churches look more like this. Other positive aspects from the participant standpoint is that there's a lot of flexibility for the sponsors, which the flexibility for the sponsors helps to make the plan more appealing, more sustainable from the sponsor standpoint, which then benefits the participants. Certainly the funding policy flexibility. The sponsors are not restricted to minimum and maximum tax deductible contributions. So they can adjust funding policy as needed or have a funding policy that fits their needs. I think we're all familiar with the situation that can occur sometimes when, if there's a hardship for the pension plan, which might require higher contributions, that might come at the same time. There's a hardship for the industry that's sponsoring a pension plan, making it doubly hard to make the contributions and cause financial hardship. This funding policy flexibility lets a church organization take more of a longer term view and to fund things over a longer period of time and not react immediately to upswings or downturns. Certainly the flexibility provides for the opportunity for lower overhead costs. So there's less money being spent on administration, which can make it more affordable and more sustainable. So as you'll see, when we get through these, I know a lot of you are listening to this and thinking, wait, there's a bad side to lower overhead costs, and we'll get to that in a minute. But right now we're focusing on the positives. And finally, the ability to adjust benefits. So, having the safety valve of knowing that you can adjust benefits if things become troublesome in terms of the ability to afford a plan can really give sponsors a good feeling of comfort that they can make adjustments if needed. And that, again, that helps them to be more willing to sponsor these programs. And that helps the participants with their programs. So the drawbacks, and you'll see, as we mentioned, a lot of the drawbacks are very similar. They're the reverse or the mirror image of some of the positives. So from a transparency perspective, we mentioned, or Linda mentioned earlier, there's no 5,500 filing requirements for church plans. So there's no required reporting of status. There's no annual mailing, no annual funding report, no zone status report that has to go out to members. So members often don't have a good insight into how the plan's doing. So they don't know if the pension plan is being funded properly or in a responsible way, or perhaps it's not being funded at all. They don't have any insight to that because there's no required reporting. Now, again, we say that there's no required reporting. That doesn't mean that all sponsors of church plans don't do some sort of reporting, but they may do something different. Some don't do any, but many do some kind of reporting out to their participants. But it's one of the risks there, that there's no transparency there. Again, it's not a big deal if everything's going well, but if things are not being operated properly or if there's other issues, it's always good to know in advance. There's no required communication of the plan. Again, that's a drawback from the participant standpoint. I know in the private sector, there's been sort of the summary plan descriptions are of course still required, but I feel like employers have put less effort into those communications in the past. But they are still an important communication. It gives the participant a place to go to find out about their plan and what it's worth. And certainly, of course, lack of communication is a missed opportunity. If you're going to provide an element of compensation, you ought to tell your employees about it and make sure they understand the value. So no required communication. It's a drawback, and it's certainly an opportunity lost for the employer. Another drawback is the less generous plan provisions. So ERISA has a number of provisions that have come in over the years that have made plans more generous. Certainly the requirement that there's a surviving spouse's death benefit and that's the default option in a private sector plan. The fact that vesting is controlled and there's a minimum or a maximum vesting requirement allowed. Those don't exist in the church plan area. Though again, many church plans do require some sort of spousal protection or have the spousal death benefit as a default, but they don't have to, and it's not uniform. So it is a drawback from the participant standpoint. The Retirement Equity Act, which put in the spousal benefit protections in ERISA plans, came about for a reason. There was a real issue that that spouses, non-working spouses especially, being left with little or no pension because of benefit elections that weren't protecting them. Vesting, you do see a lot of, there was initially, I believe, in the church plan area, a lot of folks followed the ERISA vesting rules when they changed, but there's definitely been some movement back to more strict vesting, which can make it harder for members and employees to receive benefits ultimately. Lump sum cash outs, when provided, they don't have that same market value flavor that the single employer private sector has, where you have to use 417E regulations to set your lump sum benefits. So there's some less generous cash outs potentially. And of course, one of the big ones is the no anti-cutback rules. In private sector plans or multi-employer plans, you can't reduce benefits once earned unless there's special situations. But in church plans, that doesn't really exist. And so it really does expose employees to a situation. If there is a risk or there is a downturn, could the employer take away their pension, which could include pensions that are already in payment status. So that's a real risk for participants that 10 years after they retired, for example, their benefit could be cut back. It doesn't happen often, but the potential's there. Another set of drawbacks is the funding policy. We talked about this advantage earlier, that having the flexibility to fund when needed and to not be driven by minimum required contributions provides a good advantage because it encourages employers to feel like they'll have the flexibility to afford the plan. But at the same time, it is a drawback because there's no legal required level. We're relying on the organization's responsibility to make contributions when needed and to do the things they need to do. There's an ability to skip or take contribution holidays, which again can be very beneficial to the organization, which could be very beneficial to the plan in the long term. However, if you do that too much, as we see in some plans, even in the regulated ERISA world, plans still get into trouble and end up being underfunded. So without those rules, there's the potentiality that can be even more so in this case. The third bullet here really is sort of the mantra in retirement funding. The strength of the plan sponsor can often dictate the strength of the funded status of the plan. Ultimately, if the sponsor is financially viable, they'll be able to fund the plan. And of course, anytime we're talking about funding policy, if you're talking to an actuary, we're going to bring up the actuarial standards of practice. So the lack of regulation doesn't mean that the actuaries don't have a standard of practice that they're going to follow, and they can't force an employer to follow a certain funding policy, but those standards are there, and actuaries will bring those up to the employers and talk about what makes for a good funding policy and highlight some of the risks of, when you skip a contribution year or two, the risk of that compounding and getting to a situation where perhaps the employer is not really being cognizant or grappling with the true cost of what they've agreed to provide to their employees. And so keeping that in mind and helping to fund along those lines. From a plan management standpoint, outside audits not required. The way they would be if you were filing Form 5500s and had to have an auditor report with that. And record keeping doesn't perhaps have the same requirements under the law that you would have in a ERISA plan. So these are drawbacks. Outside audits, there are certainly cases even in ERISA plans where bad actors get involved in pension plans and money is misappropriated or spent on areas that they shouldn't be. And audits do keep that keep that at bay. But even more than bad actors, mistakes happen. Mismanagement can occur. often by lack of experience. And outside audits really do a lot to try to keep that in line and to make corrections in a timely fashion. So it really is a drawback for the participant that those outside audits don't occur. Well, I shouldn't say they don't occur. They're not required. Many plans that I've worked with over the years, despite not having a requirement to have an outside audit, do in fact have an outside audit. They have something, if not 100% gap accounting done, they have something similar or close to it. And so outside audits are performed, but they're not required, which is a risk to the participant. Record keeping certainly can be an issue. If I think back to many systems, many hospital systems, for example, over the years, any nonprofit for that matter, there can be a lack of sophistication in record keeping. There can also be a high degree of sophistication, but there also can be some drawbacks there. And the idea that you're not having regular audits can allow record keeping errors or oversights to persist and go on unchecked for several years, which makes it harder and harder to fix. So we get onto plan governance here, and yes, there's less federal oversight on government, but doesn't mean that church plans operate outside any kind of legal environment. They certainly do have a legal environment they operated in, even if it's not from an ERISA standpoint. For example, state law can apply. We talk about the federal fiduciary responsibilities. Well, those don't apply, but most states, if not all states, have some definition of fiduciary responsibility that church plans will be answerable to. The nice thing about ERISA is that it gives you one rule to follow across the entire country when you're on a state-by-state basis. If you're, for example, a church program that has locations in multiple states, you might find yourself subject to multiple different jurisdictions, which can be tough. But the point is that there are still regulations that apply, and good governance is really important. Any plan, whether it's a church plan or not, should focus on good governance and really try to make sure they're doing the right things. Balancing the needs of all the stakeholders with the need for administration and investment oversight. Many groups will have managed it more strictly than an ERISA plan would be, with professional staff and resources. So it is something that's out there, and any church plan should be really looking at governance practices and how they proceed and how they approach them. We touched on plan sum funding before. As we mentioned, no imposed rules from the federal government, at least. So no ERISA minimum required contribution. However, any plan funding really should reflect the nature of the entity. So when we talk about the nature of the entity, what do we mean there? So for example, traditional local church, it's very likely that they have one income stream. That income stream is donations from their congregation. So that's one way of receiving money, and how they set up their funding should reflect the fact that they have this one source of income that they need to be really careful of. And there's probably not a lot of flexibility in that source of income. You can't just, well, you can, but it's probably difficult to reach out to the congregation and say, well, we had a pension bump this year and we need to collect more money. That may or may not be a feasible request. Versus a health system, for example, that's a church-based health system. They likely have multiple streams of income from Medicare, Medicaid, private insurers, perhaps state aid, depending on the types of populations they serve. So they can have a different funding policy because they have different sources of income and different flexibility. We get that to the bottom. The idea, again, any plan, whether it's a church plan or non-church plan, a sound investment or funding policy is really the most important thing, and being cognizant of where the pressure points are for the organization. We do see across different plans. Some plans use an actuarial funding policy where you're calculating a contribution based on that year's actuarial status. Others take more of a fixed rate approach, where they're going to contribute so many dollars per person or so a certain percentage of pay and maintain that level over many years. One of the important things is that it be systematic and consistent in how you do it. You want to design and align that budget with the source of money. And you want to have a framework for monitoring how you're doing. It's great to have a policy, but if you're not checking on how that policy is doing, is it accomplishing what you want to accomplish? It doesn't do any good. And you want to consider the long-term health of the program and what's happening. Plan terminations are one of the really tricky aspects of church plans, and it's an area where there's been a good deal of, not controversy, but that's where some bad press, so to speak, has come in the church plan area, where some organizations or programs that were church plan programs were sponsored by organizations that ended up having financial difficulties. And when those organizations collapsed or went out of business or went to bankruptcy, there was no backup for that pension plan if it wasn't fully funded. It says right there, the second line, church plans are not covered by the PBGC. And these, again, these non-electing church plans that Linda mentioned at the beginning. Without that PBGC coverage, participants can lose money. They will not receive the full benefits they receive. There's no other source of income if a sponsor organization goes out of business. And because they're exempt from the RISA's anti-cutback provisions, that means benefits can go. Again, even if it's reduced, even after it started being received. If you're a retiree from 10 years ago, you could get a reduced benefit if your organization did not remain financially viable and take care of its pension plan obligations. In some cases, there are state laws that have been set up and are designed to cover this and to require what happens when you fail to meet your obligations. But unfortunately, if the organization doesn't have any resources, then these state laws don't really fix anything. Sometimes the states or the pensioners will look at other organizations in the church area and say, well, this group should be responsible. This diocese should be responsible for this hospital or from this parish or whatever it might be. Sometimes that can work and sometimes it can't. But this is a really tricky area, and it's one of the areas that church plans have received a lot of visibility and not necessarily in a good way. So just to wrap up before we hand it over to Ted, we really want to emphasize that, again, there's a wide spectrum of plans and practices. Putting together this issue brief was very tricky because as we talked amongst ourselves, the different practitioners who helped with this, we constantly ran into things that were considerations for big organizations, but weren't considerations for small organizations and vice versa. Some that applied to your traditional churches, such as a denomination, and others that applied only to more corporate type church sponsors like hospitals. So there's a wide spectrum. And in many cases, many of these organizations are run as well or better and have a good funding policy and communication and governance policy as their ERISA counterparts. But they're not required to, which is that balance between the flexibility and the risk that exists within church plans. The shutdown risk exposure is really a big deal, and certainly something that anybody running a church plan or working with church plans should be mindful of. The idea that you really want to be careful about what happens and be funding the plan, being aware of there not being a backstop for the plan. Best practices, which of course apply of course to every pension plan, not just church plans, would cover the transparency and communication as a best practice. A good, strong funding policy that fits the organization and meets the goals is important. And of course, getting that outside review, having that outside audit done, having outsiders on a board, for example, to help balance what's going on within the organization. And for us actuaries, referring to the actual standards of practice on a regular basis with these plans is paramount. With that, I'd like to hand it over to Ted, who's going to talk about the GAO report. Ted?
Thanks, Tom. I really appreciate it. And welcome to our presentation today on GAO's recent report, Retirement Plans, Improved Communication Needed on Church Plan Eligibility for Federal Insurance Coverage. I apologize, I'm not going to be on camera today, but I will be able to walk you through our slides and findings. As mentioned, this work was requested by Representative Robert Bobby Scott, who is the ranking member of the House Committee on Education and Labor. Several conditions were in place that prompted GAO to conduct this review, and that included, we read of media reports and court cases that described allegations of retirees losing benefits because of underfunded and uninsured defined benefit plans that were established and maintained by churches or church-associated organizations. We initially found these plans to be a bit of a mystery, and our requester generally asked us, tell us what you can about these plans, since we were just sort of starting from the beginning. In response to these conditions and to our requesters, GAO examined 3 research objectives. The first being looking at available data on church plans and what's known about their administration. The second being what are the roles federal and state governments perform with respect to church plans. And finally, how expected outcomes in legal cases involving church plans affect participant benefits. To address the report's 3 research objectives, we used the following methods. We reviewed federal laws, regulations, and guidance. We analyzed multiple sources of data on religious organizations and church plans, analyzed Form 5500 data submitted by potential church plans. We reviewed a sample of bankruptcies and settlement agreements from civil lawsuits involving church plans. We spoke with various church plan and denominational stakeholders and leaders and subject matter experts. We spoke with officials from the Department of Labor, IRS, Treasury, and PBGC, and we also interviewed officials from California, New Jersey, New York, Rhode Island, and we received comments from officials in Illinois. For the first research objective, we found that because church plans are generally exempt from reporting requirements of ERISA, available data are limited and incomplete, but indicate a sizable scope of church plans across multiple industries. These industries include healthcare, childcare, daycare for the elderly and people with disabilities, substance abuse treatment centers, residential care centers, as well as post-secondary and K-12 education. Just to reiterate a bit of what Linda said earlier, according to IRS guidance, church plans under the Internal Revenue Code can be classified as belonging to one of 2 general categories. The first is that those plans that made an election under the Internal Revenue Code to have the plan treated as though it were not a church plan and to have to comply with ERISA requirements. Those plans are commonly referred to as electing church plans. And secondly, those that did not make that election under the code, and these plans are commonly referred to as non-electing church plans. For our report, we mostly use church plans to mean non-electing church plans, unless otherwise noted for context. Also, for the first research objective, we found that, according to an IRS analysis of 2019 tax filings that the agency performed for us, nearly 33,000 church employers reported $1.8 billion in defined contribution plan contributions from 589,000 participants. Importantly, these data do not include church-associated entities such as hospitals or schools. However, the W-2 filings provide only an incomplete measure, we found, of participants and contributions, as they leave some information out, particularly around they do not identify retired employees and beneficiaries. They don't. The data didn't identify contributions made to church defined benefit plans. Didn't give us data on employer matching contributions to church defined contribution plans, or contributions made by church-affiliated organizations such as a hospital. So to further develop data describing the prevalence of church plans, we obtained documentation from selected church plans for 2018 through 2022, showing 72 plans, 82,000 employers, 477,000 participants, and about $89 billion in assets. Now, for context on the denominational data we obtained, what we reported is the total of what we found through interviews with the denominational representatives or from denominational public websites. These data are limited to what we could find and are not the estimate of the universe of church plans based on what we found. Also, the denominational data that we were able to obtain directly from denominational officials, who in many cases were very helpful to provide this information, that we obtained through interviews and correspondence with them, would not normally be made available to the public. So we felt we were getting very good information the public wouldn't generally know about. Also, for the first research objective, we realized that the data we identified on church plans were limited. So what we did was we attempted to identify the minimum number of organizations in the United States that could potentially offer a church plan to their employees by searching industry-specific, publicly available federal databases that report church association and ownership, as shown on this table. And you can see we break it down by industry, number of organizations, and the data source for those data. We found, doing this process, we found nearly 336,000 organizations across the United States that could potentially offer their employees a church plan based on church affiliation present in these organizations and coded as such within the databases. We did not report the number of potential participants in each of these industries, as the number of employees were not found within each of the databases, so we couldn't sort of match against all of the databases. Please note that the 33,000 church employers identified by the IRS W-2 analysis that I described earlier are different than these 302,000 houses of worship described on the table. The IRS number earlier describes churches or houses of worship that reported actual contributions to a defined contribution plan in 2018. Here, the IRS business master file number represents all churches or houses of worship that could potentially offer a church plan to their employees. For the second research objective, we found that federal involvement with church plans is limited, with no oversight role basically for the Department of Labor due to the church plan ERISA exemption. For IRS, if they are asked by a plan sponsor, they will issue a public letter ruling confirming if a plan qualifies as a church plan under the Internal Revenue Code. And as for any other employer, the IRS collects tax-related information from church plan sponsors, such as employee retirement contributions reported on the W-2 that IRS used to analyze for us earlier. IRS also has oversight of certain tax-exempt hospitals, some of whom may sponsor a church plan. These hospitals are required to report on certain activities in order that they maintain their tax exemption. However, most importantly, we found that while church plans are generally ineligible for federal insurance from PBGC through the church plan ERISA exemption, we found potential church plans that were filing 5,500 forms and paying PBGC premiums. This is a pretty interesting story on how we got here. Although church plans are generally not required to file the Form 5500, we reviewed these forms anyway to see if any such plans had done so. In theory, the 5500 should show no non-electing church plans, as these plans are not required to file because of the church plan ERISA exemption. However, we had also found earlier in our research that PBGC in the past had issued 96 premium refunds to church plans between 1991 and 2007, totaling over $17 million, after plan sponsors had determined their plans were actually church plans and then elected to not comply with ERISA by becoming a non-electing church plan. Understanding this dynamic of PBGC church plan refunds made us wonder if this could happen again. And that's why we looked to see if any potential church plans based on a plan name were reporting on the 5500 and paying premiums. Ultimately, we found that from Form 5500 data, 134 potential church plans were reporting, covering 156,000 participants, with 120 of those plans paying PBGC premiums in 2018. At our request, PBGC officials reviewed the 134 plans we identified. PBGC determined insurance eligibility for 15 of the plans, which is done at the plan's request or upon initiation of distress termination or PBGC-initiated a termination. And I'll get into that process a little bit more just a little bit later on. PBGC made no determination on the eligibility for insurance, initially made no determination on the eligibility for insurance for the remaining 119 plans, even though 108 plans had paid premiums. Thus, PBGC did not know whether they were non-electing church plans or the plan's eligibility for PBGC insurance. Further, we found that potential church plans may be unaware that they are not federally insured through PBGC. As described on the PBGC website, agency guidance, and interviews with PBGC officials, payment of PBGC premiums does not ensure eligibility for insurance. That was something that we learned during the engagement. PBGC officials told us that PBGC does not communicate with potential church plan sponsors that they may be paying premiums in error. PBGC officials also told us that it is the agency's policy to initiate a coverage determination only if a plan requests such a determination or when a plan terminates without enough money to pay promised benefits. Officials said they do not automatically determine coverage because of the large volume of new plans paying premiums every year and the agency's limited resources to do a coverage determination on all of them. Part of PBGC's process to determine eligibility for coverage includes asking if the plan believes it is a church plan, among other things. A church plan that does not elect to be covered by ERISA, in other words, a non-electing church plan, would not be eligible for PBGC insurance, according to PBGC officials. This figure illustrates PBGC's policy for when the agency determines defined benefit plan insurance coverage eligibility. PBGC only determines insurance coverage when a plan requests a determination or when plan termination is initiated. There is no insurance coverage determination for plans that do not fall into either of these categories. And you can see how it works here. And on the bottom line, you can see where church plans fall within this. So coverage determination is not made on church plans. Coverage determination is not made on any other plans unless the plan requests it or termination is initiated. So, in the absence of clear communication from PBGC to church plans regarding eligibility rules for PBGC insurance, we concluded that the potential church plans we identified may continue to pay premiums erroneously and remain unaware of their ineligibility for PBGC insurance coverage until their plan terminates. To address these conditions at PBGC, we recommended that PBGC preemptively communicate with potential church plans, reporting on the Form 5500, to inform them of federal rules governing their plans and eligibility for insurance coverage under federal law. PBGC initially responded that conducting automatic coverage determinations for all new premium-paying plans would burden the agency. In response to PBGC's concerns, we offered a number of options to implement the recommendation. These options included that the agency could preemptively communicate with sponsors of plans whose names suggest that they may be church plans to let them know of federal requirements applicable to church plans. We also suggested PBGC could refer these sponsors to PBGC's website guidance on benefit insurance coverage and suggested to these sponsors that they share this information with their plan participants. We suggested that PBGC could also remind these sponsors that if their plan qualifies as a church plan, it will not be eligible for PBGC coverage unless they elect to have the plan covered by ERISA and submit a coverage determination form. Finally, we suggested that PBGC could recommend to these plans that they seek professional advice about the legal status of their plan. Ultimately, PBGC concurred with our recommendation and described actions the agency would take to address the recommendation. PBGC officials told us that the agency had done further investigation to try to identify the status of the remaining 119 plans that we had flagged. PBGC reviewed the 119 plans identified that we had identified and removed plans based on 6 additional criteria that they had developed. These include 1, plans that are not paying PBGC premiums, 2, plans that PBGC had determined are not covered under Title IV, 3, plans that are defined contribution plans, as indicated by plan names in Forms 5500, 4, plans that have already terminated, 5, plans whose websites and other federal reporting make no reference to religion or any religious affiliations, and 6, plans that for other reasons should be removed from the list, for example, plans that no longer exist because they merged with another plan. We greatly appreciated the additional work that PBGC did on these 119 plans. They had the information and they were able to access this, taking time to be able to come up and really whittle down the number of plans based on our first initial analysis. So after all this left 45 potential church plans found reporting on the Form 5500. After the report had been issued in early 2024, PBGC reported that it had taken actions to address our recommendations. Specifically, PBGC sent letters to the 45 plans that remained on the list after applying the 6 criteria. The letter noted that this was a letter sent pursuant to GAO's recommendation, and it advised that because the plan name contains a keyword used by GAO, for example, church or temple, that PBGC had concerns the plan may be a church plan. And the letter also referred the sponsors to the Internal Revenue Service website, providing guidance on church plans and instructions for requesting a church plan public letter ruling if the sponsor was uncertain of the plan's status. PBGC also agreed to annually review all new premium filers and provide letters to those plans who have one of the keywords used by GAO that cannot be eliminated based on one of the 6 criteria noted above. As a result of our initial findings during the engagement, PBGC corrected potentially misleading information about church plan insurance coverage on its website. Despite not knowing the coverage status of the potential church plans we identified, PBGC's website included, up until September 2022, an insured plans list that included some of the plans that we had identified. The insured plans list help page read, "This tab lists all the insured single employer and multi-employer plans insured by PBGC. PBGC officials said plans are automatically placed on the insured plans list after their first premium is received, and not because the agency has determined eligibility for coverage." The insured plans list, which PBGC said contains over just about 25,000 plans, included 91 of the original 134 plans we identified as potential church plans, and for which PBGC had not made a coverage determination. PBGC acknowledged that participants and sponsors who access the insured plans list might not be receiving accurate information about PBGC coverage for their plan. So in response to our initial observations about the website in September 2022, PBGC corrected its website by changing the insured plans list webpage to plans paying PBGC premiums, and included a statement that some plans pay premiums in error and that such payments do not trigger coverage. Importantly, while these changes might primarily apply to church plans, there are other categories of plans that are also ineligible for PBGC insurance. These include plans offered by government entities, smaller defined benefit plans, and some specialized plans that are designed for specific employees. You can see here screenshots of the search page revisions PBGC made on plans on the PBGC website. On the left is the insurance plans search page. That was the original page. On the right is what the change was made, search for plans paying PBGC premiums. The new page includes, note that in very rare instances, an employer pays PBGC premiums in error, even though their pension plan is not covered by PBGC. And then again, it repeats, paying PBGC premiums does not trigger coverage. Moving on to our third objective. We found that expected outcomes for church plan participants varied in legal cases and settlements we reviewed. For this objective, we were limited in our analysis because we could only review fully terminated bankruptcies and settled civil lawsuits. In the 4 bankruptcy cases we reviewed, we found that participant benefits were expected to be protected and kept whole at pre-bankruptcy levels, but only to the extent they were funded at the time of the bankruptcy filing. Specifically for bankruptcy cases, the only benefit levels protected were those covered by existing funds sponsors had placed into trust prior to the bankruptcy filing. Since there's no funding requirement for church plans due to the church plan ERISA exemption, these plans could be 100% funded or severely underfunded. And we saw a range in the cases that we reviewed. Participants potentially could be unaware of these funding levels due to the lack of disclosure requirements for these plans under the ERISA exemption. In the 3 settlement agreements that we reviewed, participants who had allegedly lost benefits pursued litigation to compel sponsors to sufficiently fund their plan. We further found for the third objective that in the settlement agreements reviewed, settlements awarded money ranging from $25 to $750 million to participants to help protect benefits, and in some cases, included agreements to provide participants financial disclosures similar to those required by ERISA. Following one settlement agreement, the court ordered a change in the status of one plan from a church plan to an ERISA plan. In a separate example of a civil case that we noted earlier in the report, we found that a defined benefit plan had received a public letter ruling from the IRS declaring it a church plan that the agency later reversed in response to a civil lawsuit, allowing PBGC to pay guaranteed benefits to the participants in response to a plan termination. Specifically, after the hospital center at Orange in New Jersey merged in 2003 with Cathedral Health Systems, the plan sponsor acquired a private letter ruling from IRS, which determined that the defined benefit plan was a church plan, not bound by ERISA. Thus, the plan became a non-electing church plan. However, in 2004, the hospital closed due to financial problems, leaving an estimated $30 million shortfall in the hospital's defined benefit plan, according to PBGC. Following a lawsuit brought by plan participants who had learned the plan was terminating with insufficient funds to pay benefits, the IRS actually revoked the plan's private letter ruling and its designation as a non-electing church plan. Now that it was an electing church plan, PBGC was able to then take over the failing defined benefit plan and pay statutorily guaranteed benefits to its participants. That concludes my presentation on the GAO Church Plan Report. I'll turn it back over to Linda.
Yeah, thanks, Ted and Tom, for an informative program. I want to encourage folks to put some questions in the Q&A box. We have some time for that. And I also want to say it has been a delight and a privilege to partner with the GAO on this webinar. So thank you all for that. We do have a question that I'm going to broach to Tom, and that has to do with, given the absence of funding rules and protections for participants, how does that impact the funding policy or the investment policy, rather, for church plans? You know, do they tend to invest in, quote, safer investments, or, you know, does that not come into account when they determine their investment policy? Interested in what your thoughts and experiences are on that.
Thanks, Linda. Yeah, that's an interesting question. I think that, you know, it's hard to say what they tend to do because, as we mentioned before, there's no Form 5500 database to go to see what's happening. So I have to really just go by what I've seen in my own personal practice and some anecdotal with other folks in the industry. And essentially my answer there really is no. What I've seen typically is they've been invested like many other pension funds, using a mix of fixed income and equity type investments. They generally, the ones that I've been involved with, have used professional investment advisors. They've had people who are investment professionals sitting on their boards as independent advisors as well, not selling product, but being an independent advisor with that kind of background. So they've had some good sophistication on their boards, and they've tried to do their best on a long-term basis. As some people have told me about their church organization, they're a 200-year-old branch of a 2,000-year-old company, if you want to think of it that way. So they definitely take a long-term view, those traditional churches. Hopefully that answers your question.
Yeah, thank you. We have another question about the oversight and the lack of federal oversight and what states have done to fill that gap. So our issue brief from the Academy talks a little bit about breach of contract being a viable remedy because of that contract between an employer's promise to maintain a pension plan in exchange for employee service. But we've seen some states take more active and proactive approaches to providing requirements for the plans that are in their state. So Ted, do you want to talk about some of the GAO findings about the state oversight that's going on now?
Sure, Linda. Yeah, that fell under our second. And for states, we found that church plans exempted by ERISA, non-electing church plans, states can have a potential role in their oversight. Linda, I believe you mentioned that as well. But for the most part, states in our sample, it was a small sample, oversee church plans like they do any other employer or party to a contract. And that, of course, does involve wage laws and labor laws and contract laws. We did find 2 states in our review of the 5 states that reported enacting laws that apply to church plans. We only reviewed 5 states, so this is not an exhaustive list of things. There may be more states that have enacted laws related to church plans. But let me tell you the 2 that we found. In New York, following a state charter that was granted in 1914, New York regularly conducts a financial examination every 5 years of the Church Pension Fund, which administers the pension system for the Episcopal Church. And I think their latest report is about to come out. In Rhode Island, they did a little bit more. Rhode Island enacted a law in 2019 requiring non-electing church plans with 200 or more plan members to comply with certain provisions in ERISA that require plans to disclose plan information to their participants. The legislation was prompted by civil litigation alleging underfunding by a church-defined benefit plan, as well as public pressure by participants and beneficiaries of the plan. So there is some oversight. There have been some statutes put into place. There may be more if we were to do a little bit more comprehensive review of all 50 states. If you'd like, I could respond to Richard Goring's question, what has been the movement to DC compared to the overall private sector? We do mention a little bit of this in our report. This is taken mostly from testimonial evidence from denominational officials. In those, the range of plans, we saw everything. There's defined benefit, there's a defined contribution, there's 401k, there's 403b. What we were told is that the trend is moving strongly toward 403b plans, which is a defined contribution plan. One of the things that I can say to John Whitaker's question about given the absence of funding rules and protection for participants, do church plans tend to invest in safe investments rather than risky? I can't talk to the risk profile, but what I can talk to is testimony provided by denominational officials talking about not wanting to invest in companies publicly recognized as being in the alcohol, tobacco, or gambling industries, or companies whose products, services, or activities are publicly recognized as being incompatible with the moral and ethical posture of the church. I'm reading directly out of our report. So you can see there is some sort of thematic view as to what these plans tend to try to invest in, and we heard this from multiple denominations. We did not have a discussion about sort of safe and risk investment profiles and how they do that, but we did gain this information.
I see we're at the end of the webinar here, so I want to thank everybody again, and the slides and recording are available on demand to Academy members on your member profile within the next 3 business days. And to learn more about upcoming Academy webinars and programs, visit the Academy calendar of events at www.actuary.org. So thanks, everybody. Have a great day. And thanks again to our presenters.
Thank you.